You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. It's raining very hard here. Evacuation orders again, all sorts of crazy stuff. But that's not even nearly as bad as the economy, right? What a mess this economy is. As you'd say, with all that helicopter money during COVID, supply chain issues that brought on the inflation that we haven't seen in decades. And then there was the response from the Federal Reserve to begin raising interest rates at cutthroat paces never seen before, at least in terms of the slope, right? I mean, certainly back in the Paul Volker days, you had higher interest rates, but you've never seen this kind of increase this quickly in absolute numbers. So that is where we were at, and inflation has been going down for several months, and we know that. CPI came out today. It's probably about a week before this podcast goes out, but it was still at 6%, well over the 2% target that the Fed has had for years. Now, that's why Jerome Powell has been so hawkish, even last week, talking about continuing to raise interest rates aggressively. And they could have done that without worry if nothing had happened. But in the last week, something indeed broke. We saw bank failures. We saw two of them. We saw Silicon Valley Bank and Signature Bank fail. Now, they weren't doing anything particularly nefarious. This was not the story of subprime dad and all that kind of stuff that was happening in 2008. In fact, they seem to be doing what they were kind of supposed to on the surface. Now, I don't know, maybe something will come out that says they weren't, but they were investing in conservative bonds that became worthless because interest rates rose so much. As you may recall from basic finance, bonds prices are inversely correlated with interest rates. So guess what happened? Interest rates went crazy. Bonds were worth nothing, and that's where they were left on their balance sheet. Well, things are moving quickly now, and again, by the time I release this podcast a week from now, things could get worse, could get a lot worse. So now the Fed is in a pickle, because usually when something breaks like it did, that's a signal for the Fed to back off any sort of hawkish stance. But with inflation still at 6%, that isn't exactly an easy decision, right? So what do I think is going to happen? I'll tell you. Well, whether or not rates go up in the next meeting to me is irrelevant, because I think that would just be a temporary pause. Unless there are other signs of systemic weakness that are simply too hard to ignore, the Fed's going to continue to raise interest rates until inflation is ultimately tamed. And that, I believe, is going to happen. And that is going to result in a lot more destruction to the economy than we see now. And we are hearing all about these banks in the news right now. But I'll tell you what, the real estate market is about to see a bit of a reckoning as well. There are properties that are going back right now, and not from like mom and pop players, but from major operators. So, it is a very unusual situation. And I do believe within the next few months that there will be this proverbial blood in the streets. And in that process, it is quite possible, I'm just saying, it's reality for everyone, including me, that, hey, you might lose some money, or you may not get an outcome that you really wanted or whatever. However, in situations like this, the most important thing is to keep a level head. Why? Because it's blood in the streets, right? Every time, what was Warren Buffett says, be greedy when others are afraid. I mean, others are going to be afraid, man. I mean, you're going to be paralyzed with fear if they aren't already. I mean, the mortgage lenders and all that already are. But in that process where there's blood in the streets, those who act rationally and see the big picture are going to win. It's going to be a buyer's market. I have no doubt, and it's going to be here shortly. That said, not to sound too depressing, but I wanted to discuss this real estate market a little bit more. So this week I've got our old friend Jorge Newbery from AHP. He obviously is very familiar with not only real estate, but the debt markets as well. Make sure to listen to this interview. It was definitely something I think that will be worth your time. And we'll have it right after we come back from these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula is a regular. He's one of the first to ever appear on Wealth Formula podcast. I think he holds a record for the number of appearances. His name is Jorge Newbery. He is the founder of what used to be American Homeowner Preservation, then turned into AHP. Also the founder of Debt Cleanse and a whole host of other companies that I don't even remember. Jorge, welcome back to the program.
Thanks, Buck. Thanks for having me back. I do think I still continue to hold the record.
I think you do, actually. In fact, I think this was like, okay, well, just somebody's coming close. I think Tom Wheelwright might be coming close, so we had to pull you in.
Get me back on.
Yeah, that's right. So, Jorge, there is, since we last talked, all hell's broken loose. And obviously you're very much, your business is sort of right in the middle of this whole world of debt. And so take us through what has happened from your perspective in the last, let's say, 10, 11, maybe it's been almost a year now where this.
It has. I'd say 9 months since June of last year is when they first started to be COVID. They lifted the mask restrictions, and now things are going to get back to normal. And there was talk, I think it was late June or early July when they started. I think it was mid to late June where they started talking about, hey, we're going to raise interest rates. But obviously those rate increases have come in rapid succession and by significant numbers, and that has caused. I think it's the unintended consequence of really thwarting the mortgage industry and by extension, to some extent, the real estate market, and it has created massive layoffs and what we're seeing today, which is these bank. The first bank failures in 3 years, and the biggest bank failure since Washington Mutual in Silicon Valley Bank, and that's I don't think that was intended, and I do believe the Fed's going to meet over the next couple of weeks, and the expectation was they were going to raise interest rates again. I cannot see how they can do that. If anything, they do nothing, and there's I can't imagine them cutting it so soon, but right now there is damage to the financial markets, and it's growing, and that's problematic. And so, I can sympathize.
Let's back up for a second, because I want you to. There's two things that you mentioned. One was you said mass layoffs, but employment is still really high, and that's one of the reasons that one of the reasons why we've got the Fed driving up these rates is because high inflation or high employment ultimately leading to inflation, right? So when you're talking about mass layoffs, what are you talking about?
I'm talking about in the mortgage industry. There's a huge number of companies that have completely gone out of business. A huge number of companies that have laid off significant number of their staff, including HP. Mm-hmm. And they are, and then any related business, real estate, title, many of those kind of ancillary businesses have also suffered their own layoffs. I mean, they either lay off or I don't think anyone's volume was the way it was a year ago. And as a result, the sooner you lay off and kind of align costs and right size the operation with your current volume of business, the better.
So the other thing I wanted to just kind of drill down on is because maybe a lot of people are kind of in passing hearing about this Silicon Valley Bank issue, but do you want to explain what happened? I mean, especially since sort of, again, this is, your world of lending and everything. So you probably have a really unique insight into what precipitated all this.
Yeah. I'm reading some of the articles on Silicon Valley, and I could relate. It's an unfortunate situation that the leadership at Silicon Valley was faced with. But just last week, they had there was concerns, rumblings that the bank could shut down or could have challenges, and as a result, some of the largest depositors started pulling their money out.
And why were they having those challenges? Was it because of poor investment of their assets or what?
No, I think it was more. Some of the investments were probably wise at the time, and let's elaborate on that. 2 years ago, they bought government securities, government bonds that were yielding, very low single digits. That's what they were investing in. That's what they're supposed to invest in. But the value of those has dropped as rates have increased. The values of those have dropped. So last week, when they had they started getting concerns about liquidity, they started selling off those securities. So they're selling off into an already impaired market, and they're selling these that yield significantly lower than current government securities do. And as a result, they were taking big losses on what they sold. Now, they could hold them. They would have been fine, but they were forced to sell them to meet depositor demands. Now, what's ironic is if they were less than a week later, if they were to have that same situation, they would not face the problem, because the government has now come out and say, hey, we will provide capital to banks, and they will accept those securities without them having to take a discount. So a week later, the whole dynamic has changed. But now I can't imagine the regulators expected the consequences that are happening right now. There's a huge, probably irrational, emotional fear that is, you see on TV right now, or on media reports, with people lining up outside First Republic Bank to take out their money. And I guess luckily we don't bank with any of those institutions. Although I did see that Fifth Third Bank, who we do bank with, that their stock was down by a significant double-digit amount today, but they can't let the banking system. I mean, this can't happen to multiple banks. It's 3 banks that have closed in the last week. If there's another 3 that will really, I think the emotion will overpower logic, and this will continue, and that hopefully won't happen.
Yeah, you would think that they might have learned a thing or two with Lehman Brothers, or that kind of thing, where. Or with the Great Depression,
Yeah, exactly.
Like
history.
There's a psychological component to this that they've completely ignored. Now, what's interesting about what you said, George, is I think a lot of people are feeling high interest rates, just in borrowing costs and that kind of thing, especially with real estate. A number of my audience is involved with real estate. But what you mentioned is sort of a different angle on it, which is that banks and institutional investors often are investing in those bonds, and those are plummeting in value. And so is that unique to that? I mean, that can't be unique to Silicon Valley Bank, because obviously that's what most banks are doing, right? Is buying fairly conservative stuff. So do you have any sense of what it was specifically about Silicon Valley Bank versus others that may have made them more prone to it? Or just what I'm getting at here is trying to understand, there's a few other banks out there, notably, I think First Republic and a few others that have, have been having similar problems. Are these typically the similar kind of issues that Silicon Valley Bank is having? And why aren't the major banks like Chase having those?
Yeah, I think Chase, the biggest banks probably just have more resilience, more capacity to bring on money. Although some of the banks, Western Alliance as an example, there's 3 that keep getting mentioned: Western Alliance, Pacific Western, and First Republic, as having their stocks have just dropped dramatically, like huge amounts. And Western Alliance put out a press release a few days ago stating that, hey, we have this massive billions and billions in credit lines with the Federal Reserve Bank and others that we can tap, and their balances are 0. So they're telling the market we have liquidity. But again, it's that emotional component that's coming with this. And I mean, I'd be concerned if I had $1 million in the bank, in one bank, and it's only insured to 250. And okay, they bailed out Silicon Valley, but just to be safe, let me bring it down to 250, and then move the other money to 3 different banks. I mean, that's probably what would be a prudent thing to do. I mean, the risk of losing that money that you think is safe is, I think that is a fear that would be troubling.
Yeah, an additional benefit to the big banks is that those assets are actually moving to the big banks.
They
because the perception of greater safety. Now, granted, I'm absolutely I've been in completely the Chase, J.P. Morgan world myself, so like I actually feel good about it because I feel like that's strengthening my position at least. But
you remember, it brings back an expression that was in the last crisis, which was too big to fail.
Right.
I think some of those institutions are just too big to fail. They can't let Chase go down. That's going to affect a massive number of people. Small banks, regional banks affect a lot less people. But the problem is that you get this mass consolidation of bigger and bigger banks, and then the smaller community banks. It's very tough to operate and survive.
Yeah. Let's switch over a little bit to, what your sweet spot really is real estate as it relates to debt. Talk about real estate and debt. What's going on there from your perspective?
Yeah, there's been a lot in the last 9 months. A lot of things have happened, and I'll give you some examples which kind of were before these banks, but maybe were a little bit ominous. Some of the subprime lenders were making loans at a year ago at 4%, 5% to people who had maybe credit issues or couldn't document their income. And these were non-QM loans. And as soon as they wrote them, within a short period of time, they would sell those off to these big institutions, which had a very healthy appetite to buy them. Now, what happened is in June of last year, many of these big institutions stopped buying. And some of the institutions actually, Spruce Mortgage collapsed and went out of business. And so some of these groups, these mortgage bankers, had these loans on their lines at 4% and 5%, or even sometimes even 3%. And now they had to sell them. They have to get them off their line. So they sold those, and those have tumbled in value, I think. And maybe there's been a slight uptick the last several weeks. But now we started seeing these paying loans recently originated that were selling it at discounts of 20, 25%. And again, they were just funded months ago. And now they take these bankers and other mortgage industry groups took massive losses on those. And that's very similar. It's forcing a sale into unfavorable market conditions, and you end up it ends up with huge amounts of losses.
So let's talk a little bit about how this affects your primary business, AHP, because obviously there's a number of people who listen to this program who are invested in AHP, in part because you were also our first sponsor. Although, like I said, you didn't realize that when you first started sponsoring, there was only like 5 people listening, but it still was better than NPR for you, though. But
yeah, it was.
Yeah, but so to back up real quick, I'm just going to summarize your AHP business. Correct me if I'm wrong, but basically the idea behind AHP is to buy troubled mortgages from people who couldn't pay their mortgages, and then basically buy those at a discount, and then try to negotiate with the homeowner, trying to get them to something that they can afford. Now, obviously, if that doesn't work, which is certainly possible, then you have an asset that you presumably can sell for more than you bought it at. So tell me about what's happened in that space. I mean, at 10,000 feet looking down, I would think, well, gosh, you just said that, we've got paying assets being discounted by 20%. This should actually be good for your business. Is that right? I mean, what's going on?
It's okay if you're a buyer, not so good if you're a seller. So during COVID, a couple of things happened. One is we bought a lot of loans. There are a bunch of opportunities at the beginning of COVID, call it second half of 2020 and first few months of 2021. We bought a lot of loans, tens of millions of loans. And some of those were easy to resolve. We go to the homeowner to do a mod. Others, hey, I don't want the property anymore. We do a deed in lieu. We'd sell those properties at once we had control at great markups. And we did some large loan sales in that era. And I'd say it peaked probably December 2021, where we had a good sized loan sale. And I remember the pricing was historic. It was never had HP sold reperforming loans at a higher price. But during the same period, across the country, there are foreclosure moratoriums put in place, and in many places you couldn't foreclose. Some places you couldn't start the foreclosures. Many places you could progress to the foreclosure, but you couldn't get a judgment or take it to sale. And so that kind of for the borrowers that were more difficult to resolve, some of them just, hey, I'm not going to pay. I'm not going to talk to you, and you can't do anything. And that was a mindset that happens. There was strategic defaults last time, and here that happened. But that all ended at the end of 2021. All the foreclosure moratoriums were lifted, and we could proceed with foreclosure. And we continued. We did a handful of loan sales in early 2021, mostly on the smaller side. Again, we were kind of had run off many of the reperforming loans. But now, as we started proceeding with foreclosure, we started getting more reperforming loans. We also started those that weren't receptive. We just continued with the foreclosure process. And towards the end of the year, our plan was to we put everything up for sale. Almost everything in our portfolio we put up for sale, and we put it through a large investment large investment brokerage, and they put it to market, and the bids were not what we expected. In fact, when we first started talking to them in the early fall, hey, this is what to expect, and then it just kind of dropped, and then by the time it was end of November, when they had all the bids in, hey, this is not what we were talking about, and also I think they made a few missteps themselves, which kind of were more noticeable probably because the market wasn't doing so great. So we aborted that sale. We didn't sell any loans as we had planned. And what made it a little worse is that we had one of their thoughts was to make the loan sale as big as possible. We could attract some big institutions to the sale. And so as a result, in the last few months of the year, we stopped doing our regular kind of smaller sales, and then which also kind of reduced our cash flow. So not a good situation. By the end of the year, by middle December, that sale was canceled, and we started selling through our more normal channels. And we did get some higher bids, but as those went to closing in end of December and through January, we had a lot of people backing out, a lot of people trying to reduce the pricing. The market conditions have just continued to deteriorate.
In effect, this is, as you alluded to earlier, this is a little bit parallel to the banking situation that you talked about with Silicon Valley, in that you've got effectively these bonds, right? I mean, these are mortgage-backed securities or whatever, but they're bonds that you've basically renegotiated, and you've renegotiated at them for a price, and ultimately interest rates have gone up. So they've lost some value. Is that a fair parallel?
That's a fair statement. Yeah, that is a fair statement. And remember, they're mortgages. These are no longer, some of them were in mortgage-backed securities, but by the time they get to us, they're whole loans. We own the whole loan.
But you're
right.
The question is then, so are these securities, or are these loans primarily paying, though, the ones that you've renegotiated, or are they not paying?
Some of them are, and some of them are not paying. And some of them we've just continued through the foreclosure process. So put two categories. One is loans that we modified maybe a year ago, or a year and a few months ago. And, regrettably, some of those were modified at 3.5%, 4.5%. And now to sell those is tough because the people say, hey, they're paying perfect. But, interest rates right now, 7% is what, a new loan is going to be at. So we're going to reduce it just because it's written at a lower rate. Today, we're writing all the modifications get done at 7.5%. But there's this period where we have these loans which just hadn't had enough performance to sell. Now they do, but the performance is maybe good, but it's at a low interest rate. The other side, the bigger portion of our portfolio is non-performing loans, where the people, we were able to start moving the foreclosures forward at the end of 2021. We're getting to right now, some of those foreclosure sales are being completed. At the last minute, people come in and say, hey, I want to do a deed in lieu or some other type of option. And that is those are our best options right now. And that's, I think, we have changed the mindset from selling these loans to working these loans out. If I can get a deed in lieu on a home because a family can't afford it, or maybe the homeowner passed away and we work with the heirs, we can then sell the home. And the real estate market especially for affordable homes, is still pretty robust. It's not like it was a year ago where there's multiple offers, but the prices are still pretty strong and significantly more than when we first bought these loans. So we are seeing gains there. It's just been slow going. And
so the net effect of that is not being able to necessarily have enough cash flow, but you're still cash flow positive, but you're not necessarily able to meet the the monthly payments, or have you been?
Yeah, so there's two things. One is paying monthly distributions, and the other is paying redemptions. And redemptions are on pause right now. Distributions we have largely paid. We're still, we're staggering them because cash flow has been tight. And I'll add one other component to this. We funded both with debt and with equity. So we had about a year ago, we had about $25 million in debt. In fact, 6 months ago, we had $25 million in debt. We have that debt provider is actually, we work with a hedge fund, but behind them is money that came from one of the banks that I mentioned, is in trouble right now. And they have, that loan matured, and they gave us an extension, but we had to pay them $3.5 million. So basically everything we had, from our resolutions 6 weeks ago, we gave to them. And this week I'm supposed to give them another $2 million. But the good news is the other $2 million will get us a 6-month extension, which will be a relief and will allow us to kind of, over the next few weeks, return to more normal operations in terms of cash flow, but satisfying their demands. And, they're in part of the problem. Part of the dynamic that's happened is a lot of people who have been loaning money, it wasn't their money, it was other people's money that they borrowed. They have credit lines and whatnot, and then they borrow money and they loan it out. But now that they need it back, and they can't always control. And it's in this market, things have become very unpredictable. So that's been a big challenge for us the last several weeks. I've tried to navigate as best I can, but I expect distributions will be back to normal timing, if not April, then by May. I think in the meantime, to get through these few months, I've been staggering them, and we've been getting them out, but it's been slower than expected. Money's coming in, but again, I've had to prioritize the debt, and then so think about it like this: the debt is currently down to $16 million. Pay them another $2 million this week, so now it's down to 14, and again, it was at 25. And once over the next few months, I expect I can pay off that debt, and then as money comes in,
right,
we're not only paying distributions, but we're paying redemptions and getting everyone back their money, which I want as much as anyone else. It is this extraordinary circumstances, and maybe I didn't react fast enough. It was tough to kind of envision how bad it's gotten. But here's where we are. So the good news is with our redemptions, and it's probably frustrating for investors, is that when it's not mandated that we redeem the money. We historically, before COVID, we always did within 30 days. Now it's gotten to it's taken a lot longer, and but there are enough assets if we were to sell them in a normal, or to resolve them. We did this exercise a few weeks ago. If we take all our current assets and what's our target resolution and how much money would be left, and there's enough to pay off all the investors and then a modest amount over that. And as long as and I want to say that's even expecting some market dislocation like we're having right now. So we'll, not to say we're immune to anything that comes at us, but within reason, I think we'll be in good shape. But these few months right now have been very challenging.
Yeah, and it's interesting to me, and looking at this from different sides of the fence here, being on the owner's side and all that, is that people wonder. People are asking the question a lot. Well, I mean, weren't you prepared for this? Right? Weren't you prepared for this? And I think it's an interesting question, right? Because at the end of the day, the answer is, yeah, we lived through 2008. We kind of understand that things can change quickly, but I don't know that you can ever prepare for something that you've never seen before. For example, in the case that we're talking about, people need to understand that, rates were going up, and people may have prepared for rates going up, but the degree and the acceleration of how quickly rates went up is unprecedented, right? People bring up Volcker days and stuff like that, but absolute numbers, these rates went up much faster than the 80s hyperinflation reaction by Paul Volcker. So what else can you do? Because to me, like, I think about this and I'm like, well, if you expect, the absolute extremes on things to happen in your underwriting, you're never going to buy anything, right? I mean, so how do you see this problem, and what would you do? What will you do if you do anything differently in the future?
Well, I'll tell you a couple of things. One is not to be lost. We did build not to be lost on people's minds. We have the loans, at least in AHP servicing. We have not only the loans, but we also have the servicer. We built a national servicer, which when I first started building it, the market had gotten fairly less attractive to buy loans at the time, and instead we built this servicer, and I was anticipating the next downturn where we could better control the dispositions. Mm-hmm. So here we are, potentially on the doorstep of the next downturn, and we are talking to, and this has been going on for. We've had a couple of potential buyers and buyers of an interest, strategic partners in the servicer, and this continues. We had one that we spent a lot of time with last year. I think they were kind of caught up in the challenges of last summer and fall, and they moved on. They moved away from it. But now we have 3 potential buyers that we're working with, and again, they're all buying not buying the servicer. They're buying an interest in the servicer. The biggest one is the one that is also the best capitalized, and they want and they own a lot of mortgage servicing rights. That would be I need to bring in more loans into the servicing operation. That would generate profit on just the operation. The reality is, as we built this operation, the asset, our asset investments have subsidized the build out of the servicing operation, and now that needs to perform independently on its own. They're together, but asset sales at some point we're done. We need to succeed at the servicer, and so that is a big focus. To say what we do differently, I mean, I know the market. Yeah, honest. So this goes through my mind. I try not to think about it. I could have put everything out for sale, non-performing, everything. The last quarter of 2021, or even the very early part of 22, and we could have taken advantage of record low interest rates and the market, the heated market that was out there then. I mean, it's easy to say that that's what we should have done. And I tell that. I mean, I try. What do? You can't change it. So you kind of have to just work with what you have and make the best decisions based on where we stand. We still have tens of millions in assets, which can be resolved. And, we have 51 deeds in lieu in process. We put a huge priority on resolving these loans. I'm paying one borrower $150,000 to sign the deed in lieu to this house in Brooklyn that it's going to take me a couple of years to foreclose. It's worth it. She actually has some equity, and it's a good resolution. We're going to let her stay for a little while on a lease. So we are being more aggressive than ever. And in retrospect, I should have done this a year ago. But a year ago, a year and a half ago, people didn't feel the pressure that they feel today, because these foreclosures are moving forward, and we're actually like, okay, the borrower's got to be thinking, if I don't do something, then I could actually lose my house. So let me talk and make a deal. And so that's what we're doing. I see others kind of faced with some of the circumstances that we are, and it's easy to kind of like, let me close shop and do it again, and and start over. And I've been reading up on others, Apple. There's a lot of businesses that have had, and not to compare myself to Steve Jobs or Apple, but it's interesting to see, how even Starbucks, how going through these periods of distress, And we've shed a lot of employees. And in fact, I'm surprised with how relatively few employees we're working with and are still getting the job done. And, so we're cutting costs everywhere we can. I think that these types of exercises, unfortunately forced, but are, will strengthen us for the future. But right now it is tough. But, as we kind of get through the worst of this, I think we'll come out stronger.
Yeah. I mean, what you're talking about is ultimately we're seeing it cross-border in real estate too, right? Like if we had sold our portfolio, if we'd known what was going to happen and we sold, we would have made so much money. And no, we're still making money, but it's not, and we're definitely going to take a haircut because of what's going on in interest rate wise. You mentioned that it's not a good time to be a seller. Is it a good time to be a buyer yet?
So today I submitted, we bought a pool of, on December 30th, which is the last business day of the year at 8 p.m. I closed a pool from a hedge fund that was, another buyer had backed out of it at the last minute. So we bought it. And they financed the majority of it. It was a good opportunity. In fact, they financed almost all of it. But it was a good opportunity. They had to close their fund last year. So we were able to, it was an opportunistic buy, which we haven't resolved any of the assets yet, but we are working on those. I think we'll start seeing our first resolutions over the next 30 days. It was a great buy. Today, I made a bid on a pool that was brought to me on Friday, just the stuff we used to buy. And it's from one of the biggest originators in the country. It is a pool with a lot of issues, but we can buy them at what appears to be an extraordinary price. I'm going to have to find financing for that or something like that. That would be just specific to that pool. But we're not, it's been, we need to move forward. We need to operate as a business. I see opportunities, find a way to seize them. I mean, that's ultimately going to generate revenue and profit and things if things go as expected to AHP, which is going to be helpful for everyone.
Yeah. And I think there's a lesson in that too, because I think part of what happens is people get so terrified about what's going on right now. But, if you're in this consistently up and down, presumably, you may have taken a haircut, you may have lost a little bit of money or something on various things right now, but you have to look at the other side of it, which is, okay, well, that means I should be buying now, or I should be investing in things and not getting terrified and sitting on your hands. Because this is when these are the opportunities. These are the opportunities. And because of fear, people don't take advantage of them. And we haven't quite gotten there in apartment buildings and that sort of thing yet, but I mean, we're right on the precipice of it. And hopefully people will react rationally and not out of fear.
No, I agree. You'll see in 2008, I mean, there were some great opportunities, 2008, 9, 10, 11, 12, 13, great opportunities, but so many people had lost money in real estate there. I'm not doing that anymore, right. But it created these great opportunities. Now the same thing. A lot of people made money for several years. People are likely going to take hits over the next few years. It's odd. I'm curious, so far real estate has not, at least residential real estate, single family, has not taken the hit. In some markets it has, where there was hyper appreciation, but it will be interesting to see. But by and large, on the affordable sector, we've seen some reasonable measure of stability. But offices, hotels, those have been, that's hard hit. And we are starting to see some big office buildings with defaults. And that will be interesting to see where that goes. I mean, the reality is that America has changed how it interacts with office buildings, as an example. Mm-hmm. And, a lot of people don't go to the office as much as they used to, if at all, or even have an office. And so, what are these buildings going to be used for? It's hard to say. Or does America kind of go back to where it was? It's hard to say. It's hard to imagine that would happen. But either way, there's a price at which those are a good value.
Yeah, I'm curious about your take on this. I know you're not an economist, but, I think about like all of this conversation that you're having, that we're having, with apartment buildings. And in the meantime, unemployment has record lows, inflation continues to go. It's like schizophrenic economy, right? Like where, what's going on here? Like one part is like, oh boy, we're in trouble. And the other's like, we're still sitting in the day in the beach or something. Like there's no, what do you think is driving this sort of strange double-headed monster?
I think someone was, it wasn't me, but someone was talking about this being a top-down collapse. And it is starting at the top. A lot of these big funds that had a lot of leverage that was smart a year or two ago is now looking like, oh, we're in trouble. And so it isn't, the average everyday American is suffering because of high prices, high cost of living, price of eggs, being an extreme example. But there's this, my wife comes home and this grocery bill is huge. And that is, and that's for everybody, and that's tough. But but
that's driving wages up too.
Yeah, it has to in order for people to pay to live.
Right. No, and I get that, but I guess then we
put all these factors together. What is it? What do you come up with? I don't know. But this. I don't know. The next few weeks and the next few months will be very interesting. I think that we're starting with these banks toppling. I think that's the beginning of something. If anything, there's an emotional, it's going to trigger fear and emotions that, will create opportunities.
Particularly because, as you alluded to when we were offline, the Fed's talking about raising interest rates still. Now, I haven't really heard anything since this whole thing has happened. But, if they continue to raise interest rates while watching banks fall apart, it's sort of unbelievable that would happen, but it might. What's your take?
Yeah, the forecast was that they were going to raise the rates again at the next meeting, which is the next week or two. That's changed. I think as of today, they're thinking that they'll let it stay the same. At some point, the Fed is partly responsible for this. I don't think this was the intended consequences, these banks collapsing. And that is, they did say they wanted to create pain in the economy in order to tame inflation, which seems logical and worthy, but it's gone to an extreme. And I wonder now they have to they likely have to backtrack a bit by leaving the rates the same or by even dropping them. I can't imagine the drop will happen at this meeting, but maybe in subsequent meetings, depending on where this economy goes. One of the challenges when they dropped rates so low during COVID is that's the big tool to stimulate an economy is to drop interest rates. And it worked. Mm-hmm. It worked probably too well during that period. And now they've made up for it, but it's having extraordinary consequences of its own.
Well, they have dry powder now if they need it.
Yeah, they can drop it again, which they will, which at some point they're going to. Now they actually have that tool back in their belt. Hey, we can quell things by dropping rates. And that if things get really bad this week, that becomes plausible for the next meeting.
Yeah. Well, anyway, good stuff, George. I appreciate you being on. I know you're getting a lot of email from the audience, so I thought it'd be good to kind of explain what's going on. But it sounds like overall your perspective on the business and investor money and stuff is actually pretty solid. It's just a matter of cash flow issues and, adjusting to what's going on and potentially taking advantage of what's coming your way.
Yeah, absolutely. There'll be more opportunities, and we'll find a way when there's an opportunity a great opportunity to try and seize it. And I think we'll do that. And navigate this. Those that survive will likely thrive. There'll be a much thinner in terms of mortgage servicers, originators. There'll be less of us. There already are than there were 6 months ago, and they'll continue to be less. So it creates an opportunity for those who can navigate this.
Good stuff.
And I appreciate,
George.
and for the investors, I appreciate everyone's patience. It's not, this is trying times, but my focus is it's in the best interest of everybody to, navigate this and come out the other side as strong as possible.
Thanks, George. Thanks for being on the program.
I appreciate it, Buck.
I'll be right back. Welcome back to the show, everyone. Hope you enjoyed it, or I don't know if you were enjoying it or if you were scared, but either way, it's stuff you got to know. And again, I'm just here to remind you, even as George said in that interview, it's not a good time necessarily to be a seller right now, right? But it is probably a pretty good time to become a buyer. And I think what we're going to need to be aware of is that we're going to have opportunities to buy within the next few months, and we have to not behave irrationally and, get paralyzed with fear. This is really important because this is when you can make a lot of money. Anyway, that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.